Okay, we're going to get started, but before we dive into the training, I want to read this important disclaimer. Futures and options trading have large potential rewards, but also large potential risk. You must be aware of the risks and be willing to accept them in order to invest in futures and options markets. Don't trade with money you can't afford to lose. This is neither a solicitation nor an offer to buy, sell futures or options. No representations being made that an account will or is likely to achieve profits or losses similar to those discussed in this video or on this website. The past performance of any trading system or methodology is not necessarily indicative of future results. And then CFTC Rule 4.41, hypothetical or simulated performance results have certain limitations. Unlike an actual performance record, simulated results do not represent actual trading. Also, since the trades have not been executed, the results may have under or overcompensated for the impact, if any, of certain market factors such as lack of liquidity. Simulated trading programs in general are also subject to the fact that they are designed with the benefit of hindsight. So no representation is being made that any account will or is likely to achieve profit or losses similar to those shown. All trades, etc. discussed in this video or website and the product materials are for illustrative purposes only and not to be construed as specific advisory recommendations. Now, this is important for three reasons. First, it is actually required by the government. And second, there is risk of trading in any kind of market or in any kind of trading or investing. If there wasn't, there'd be no opportunity for profit potential. Just think of a certificate of deposit at your local bank. There's practically no risk there. But you only get paid 0.5% after 1 year, if that. So where there's profit potential, there's going to be risk. Third, in order to really go after the profit potential, you need to get educated. And you need the appropriate level of trading education. Without it, it's unlikely that you'll be able to overcome the risk. So with that caution, let's get right into the training. Hi, this is Bill Paulos from Profits Run. First of all, congratulations for making the decision to get this training. What you're about to discover could dramatically change your financial future. Because in this video, I'm going to give you a step-by-step plan for potentially growing a $5,000 account into $60,000 in the next 6 months trading options. Now, I'm excited to get started. But first, let me very quickly introduce myself in case you're unfamiliar with me and my background. Again, my name's Bill Paulos, and I've been trading the markets since 1974. It's my passion. It's what I love to do. I think I was attracted to trading in the first place because of my background as an industrial engineer, which is the field of study that I got my first degree in. I learned how to create, test, and perfect systems. For many years, this is what I did in my automotive career. That was my day job. But my night job was trading the markets. After I got my MBA from the University of Michigan, I thought it might be fun to start a business one day to teach people what I knew about trading. Well, that dream finally came true for me in 2001 when I started my financial education company, Profits Run, along with my son, Greg. We literally started it from the kitchen table, and now, over 10 years later, we have a modest office and over a dozen full-time employees that have helped us train over 50,000 regular people from all around the world on how to become better, smarter, and more effective traders. From the beginning, my goal was to simplify trading so that everybody could have a real shot at potentially creating some extra income in the markets. And I think my teaching hits home with a lot of people since so many of them keep coming back to us for more and more training. So I'm glad to have you here with me today, and I hope you pick up some useful techniques. Okay, now let's jump right in and talk about how it's possible to turn $5,000 into $60,000 in 6 months. First, I'm going to give you an overview of the trading plan, and then I'm going to dive deep and show you step by step how to implement it. To do that, we have to understand our trading goals. And here they are. We're going to use 1 or 2 strike in the money options with at least 45 days until expiration. We're going to trade options on the S&P 500 stocks that are priced at less than $40 per share. We're going to apply proper risk management. And we're going to apply a simple trading method that gives you a decided edge. And then you'll want to increase your position size as your account grows. Okay, let's take the first goal. Use 1 or 2 strike in the money options with at least 45 days until expiration. We're going to be directional trading short-term swing moves in the markets. And so we want to select in the money options to limit risk and also to track the movement of the stock price 60 to 80 cents on the dollar. So if the stock goes up $1, our option will go up 60 to 80 cents. And we want to select options that have at least 45 days until expiration to minimize theta decay or time value decay. And I'll talk more about this in a little while. Next, we want to trade options on S&P 500 stocks that are priced at less than $40 per share. Trading options on stocks less than $40 per share allows you to select lower cost options and therefore more contracts per trade. Now, there are over 100 stocks in the S&P 500 that trade for less than $40 per share to choose from, so there will be plenty of trading opportunities. Now, this is the most important goal of all, applying proper risk management. Proper risk management is a must. Without it, you will lose. With it, you have the chance to do very, very well. Now, when I'm talking about risk, I'm talking about the amount you would lose on a losing trade, not the amount you paid for the option. And so the risk per trade should be no more than 5% of your account size. For example, with a $5,000 account, you would risk no more than $250 on the next trade. Furthermore, you want to plan on losing no more than 50% of the price you paid for the option. That means you can buy $500 worth of option contracts and sell your options at $250 if it's a losing trade, netting a loss of $250. Now, if one option contract costs $200, for example, then you could buy a maximum of 2 contracts. Why? Because you take the $500 that you could apply to the next trade, divide that by $200 per contract, and that tells you you can buy up to 2 contracts. And let's say you bought those 2 contracts times $200, that'd be $400. If that was a losing trade, you would sell those options for $200. Having paid $400, you would lose $200, which is within your risk management parameter of, in this case, $250 or 5% of your account size. Now, as your account size grows, you can then add more contracts on future trades, but not before. You always have to follow the 5% rule. Okay, next is apply a simple trading method that gives you a decided edge. Now, I'm going to teach you such a method in just a moment. You have the potential to average 80% gains on winners and 40% losses on losers, and win 2/3 of the time. Now, that is really an excellent performance level, but it is possible. Now, by entering into 2 trades per week and achieving the above performance, you do indeed have the potential to turn $5,000 into $60,000 in 6 months. Now, of course, that is not guaranteed, but the potential is there. And you're risking a maximum of 5% of your account size along the way. So you're not taking wild bets to achieve this. So that would be 52 trades, which is easy to do given the fact that there are over 100 stocks to choose from that meet our stock selection criteria. Now let's look at some data. This data assumes that you make 2 trades a week and that your performance levels average 80% gain on the winners, 40% losses on the losers. That's the average. Some gains are going to be a lot higher. Some losses are going to be higher, not a lot higher. And some losses are going to be lower. Now, at that performance level, on average, you would be able to achieve a 10% gain on your account per week. So if you started with a $5,000 account at the end of week 1, your account would grow to $5,500. And then as your account size grows, you can trade, as I said, larger position sizes, more contracts, which will escalate the growth of your account, as you can see here, week by week by week. So here are the first 13 weeks after beginning with your $5,000 account. You're up to $17,261. Now, it isn't going to come in actuality this smoothly week after week after week. Some weeks you're going to do a lot better. some weeks not as well. But this gives you an idea of what is achievable. And looking at the last 13 weeks, you can see at the end of 26 weeks, your account size would stand at $59,590.88. Now, nobody can promise you this kind of performance. All I'm trying to do here is open up your mind to accepting the potential that exists properly trading options with proper risk management. Okay, with that background now, I'm going to show you several chart examples that I'll use in teaching you a simple trading method that indeed would give you a decided edge. And an edge means that you have the odds in your favor. It does not mean you're going to win on every trade. That's why you have to pay attention to risk management. But it does mean that over a series of trades, the odds are in your favor. And now I'm going to show you several chart examples to teach you how this all works in practice. Okay, here is a stock symbol OKE. This is a daily chart, compliments of freestockcharts.com. And this is an S&P 500 stock. And I'm going to be showing you some examples here where the stock price may be a bit over 40, but then later on you'll see the stock sells off below 40. But the trading technique I'm going to show you doesn't care what the price of the stock is. The only reason we care about it is we'd like to be trading lower cost options. So the lower the price of the stock, the lower the cost of the options as a rule. Okay, here's the technique. It's very simple but very powerful. And let's just look back here. This red line is a 50-day simple moving average. And the blue line is a 20-day simple moving average. And down below here we have the stochastics %K with an 833 setting. And the stochastics indicator is an oscillator that tells us when the market is overbought, when the stochastics is on the high side, and oversold when it's on the low side. Now what we're going to do is focus on first the 50-day moving average. So in order to take advantage of a downward trending stock, we want the stock price to be either below the 50 moving average. That's requirement number one. Number two, the stochastics %K must be greater than 60. And right here in this particular case, you can see in the pop-up window it's actually at 95, so it's well above 60. So I want the price to be below the red 50-day moving average. I want the stochastics to be above 60. That means the stock is rallying in an otherwise downtrend. And so I want to be looking to buy a put option, which is the right to sell the stock after the stock has rallied. So I'm going to be wanting to buy a put option right in here, and I'll show you an example of that in a moment. You can see that after this bear market rally, the stock then sold off dramatically, which would have given us a very, very profitable trade. Now, what about the 20-day moving average? Well, this is kind of a filter that says if the 20-day moving average is also below the 50-day moving average, that gives you the stronger setups. But that is not an absolute requirement. But it will give you the stronger setups. Once the stochastics is above 60, you track it each day until it drops 5 percentage points from its highest value. So in this case, it was at 96.66. You can see that in the pop-up window. Then 9651, then 9854, 95499283, right there. Now that's more than a 5 percentage point drop from the high of 98. And that's where you would buy the put option, right there. Now then we're going to risk half the value of the put option. If the market keeps going up, the put option is going to lose value. And if our put option drops in half, we sell it and take our loss, around 50%. If on the other hand, the market cooperates and moves back down, that put option is going to go up very significantly. It can go up 50%, 100%, 200%, even 300%. And a simple rule as to when to sell your put option for a profit is just wait for a close above the previous day's high, like occurred right here with this green candle. But only after the percent K is below 40. So in other words, I want the percent K to start dropping once we're in the position to below 40, and then I start looking for a close above the previous day's high, which occurred here. So this would have been a dramatic gain on this trade. Now let's stop right here and go to a good options broker trading platform and take a look at put options. Okay, here I'm at the Options Express trading platform looking at the option chains for OKE. And this is the current pricing of options with OKE trading at $38.92. So what I've done is I've typed in symbol OKE. I want to look at puts. I'm looking at the November expiration because that gives me at least 45 days until expiration. I click on View Chain, and that brings up the options table. Now, because in this case OKE is trading at $38.92, I want to trade a 1 or 2 strike in the money option. That means an option that is priced with a strike price above the current selling price of the stock. For example, $40 option. And for this option, you can see the bid-ask price, $2.80, $3.90, which means that if you're buying this option at the market, you're going to have to pay $3.90. If you're selling this option at the market, you would have to accept $2.80. But when you're placing an options order to buy, you never want to pay the asking price. And you won't be able to buy it at the bid price, but you can usually buy it in the midpoint between the bid and the ask. In this case, about $3.30. Now let's take a look at, well, why not buy a $30 put? You only have to pay 10 cents, 50 cents, or split the difference, 30 cents. Why pay all this money when you can buy one for 30 cents? Because the 30 strike put is what you call an out-of-the-money option, meaning in order for this option to have real value before expiration, the price of the stock would have to fall from $39 all the way down to well below $30. That's not likely to happen, and that's why this option is priced so cheaply. This one, in all probability, will expire worthless. So you don't want to buy that one. We want to buy the 1 or 2 strike in the money, and here's why. Let's click on Calc, and that brings up what is called the Trade and Probability Calculator. So here's our symbol, our month, our strike price of 40, put. Let's say we want to buy one, and let's buy it at, say, $3.30, the midpoint of the bid ask, and click Calculate. Now that brings up what's called a risk curve. This shows you the relationship of the profitability of the put option versus different stock prices. Right now the stock's at about $39 a share, and we had to pay $330 for this put. Now the November put option will expire the 3rd Friday in November. And if the price of the stock's trading at $40 at that time, this option will expire worthless. If it's trading at $41, it'll expire worthless. Anything above $40 will cause this option to expire worthless, and you would lose $330. Now, on the other hand, if the stock at expiration was trading at $36.70, this option would break even. Why? Because it would have $3.30 of real value. $40, which is the strike price of the option, less $36.70, the price of the stock, is $3.30. Why? Because when you buy a put option at $40 strike, that gives you the right to sell the stock, but not the obligation, at $40. So if the stock's trading at $36.70 and you have the right to sell it at $40, that gives you an option with real value of $3.30. Now, if the stock's trading down at $34, now your option's making good money and you've got a profit at $264. If it's trading at $30, you got a profit of $621, almost 200% from the $330 you paid for it. But it gets better. This is the risk curve at expiration. Here's what it looks like the day you buy the option. That's the green line. Because the day you buy the option, it not only has real value, it also has time value. For example, with the stock trading at $38.97, you buy a 40 strike put option. It has a real value at that time of 40 minus $38.97 or $1.03. But you paid $3.30 for the option, so it has additional value above the $1.03, or in this case $2.27. That's time value. But that time value erodes as you get closer to expiration, and that green line will collapse into the blue line. So when we put the option on, it's the green line that's operative. Now, in order for us to make money, the next day, if that stock trading at $38.97 dropped to $36, which it could, you've suddenly got a $133 profit, or about 35% of what you paid for it. And if it kept dropping down to 32, now you're looking at a very big profit. $411, now you're over 100%. Now, if this trade takes a week or two to develop, and most of our trades, we're going to be in a week to 3 or 4 weeks, this is what the green curve would look like. You see, it didn't really drop that much. And so we get profitable a whole lot quicker than you would at expiration, as shown here with the blue line. Now, if the trade goes against us, the stock starts to go up in price instead of down. As soon as the value of that option drops 50%, right about there, you get out. Take your loss and go on to the next opportunity. Now, I hope you notice something looking at this curve. You have almost unlimited upside all the way until the stock goes to zero, but you have very limited downside. The stock could go to the moon and you could not lose more than $330. And you only plan to lose half of that. So with options, you have the power of leverage, but you also have limited risk if you buy the right option. In this case, a 1 or 2 strike in the money option. Do not buy the out of the money option. It's a very cheap option to buy, but it's cheap for a reason, because it's very likely that it will expire worthless and you would lose the entire amount you paid for it. Okay, while we're here, let's go back and look at a call option. Okay, I just type in calls, hit view chain, and that brings up my call option price table. And let's say I wanted to buy a call option because my trading method told me that OKE is likely to go up. So what do I want to do? I want to buy a 1 or 2 strike in the money call option, which would be a strike price below $38.91. So in this case, I'd choose the $37.50 call option. That's 1 strike in the money. 35 would be 2 strikes in the money. 32.50 would be 3 strikes in the money. 1 strike in the money in this case is fine. So here's my bid ask, 230, 310. Now this bid ask, both on the put and the call in this example, is wider than I like. I usually don't want to see this bid ask spread more than 10% of the bid price. So when you encounter this, it's very important to Never pay more than the mid price, between the bid and the ask, so that you're not overcharged for the option. Okay, so let's click on the Calc button, and that brings up the trade and probability calculator for the call option. So let's buy one at $2.80, which is the midpoint. Click Calculate. And that brings up the risk curve for a call option. And notice it's the opposite of the put option curve. The put option curve extended down here and then went up to the left. The call option goes in reverse. Why? Because when the price of the stock goes up, the call option is going to gain in profitability. If the stock price goes down, the call option is going to lose in price, but only to a maximum amount, in this case $280. And likewise, the day you buy the option, it's the green curve that prevails because you still have time value in the option. And as the price of the stock goes up, you have the opportunity to make a great deal of money in a relatively short period of time. By the way, unless you're deep in the money on your option, it's a good idea to sell your option the first week of the expiration month, because the expiration month will decay the time value of that option rapidly, and that green line will collapse very quickly. So you don't want to hold the option that long. On the other hand, if you're deep in the money, meaning the stock has gone up a lot, then it doesn't matter much. You see the green line here is right on the blue line anyway. Most of the time value's already been pulled out of the price of the option. Okay, armed with that background, now let's go back and look at our chart example, applying our simple trading method for more opportunity. Okay, back to our simple trading method. This was the trade we initially reviewed, and now the market rallies. The 50-day moving average is still going down. Market rallies. The percent K is now above 60. It's at 80 something. And we wait for it to drop 5 percentage points. 80, 80, 74, right there. So we go ahead and buy a put option right there with the stock trading at $45, right in there. We wait for the percent K to drop below 40, and as soon as we get a close above the previous high, we get out. So in this case, you would have made a little money, but not much. But that's okay. You go on to the next opportunity, which is right in here. The percent K is above 60. It peaks at 86. It drops to 76 right here. You go ahead and buy your put option. And the market initially goes against the trade, but it won't stop you out. The put option will not lose 50% of its value with a counter move like this. Then you wait for the percent K to go below 40 and a close above the previous high right here, and you can sell your position with a very nice profit. Now, you don't have to wait for the exit rule to close above the previous day's high. You can sell your put option anytime you want. In other words, if it achieves about an 80% gain from what you paid for it, a good practice is to sell half and then let the second half ride until you get the exit signal. Okay, here now we've got the market trading above the 50. We've got the percent K below 40, because now we're looking at buying a call. And again, I want to see the percent K change by 5 percentage points. It's 30, it's 25, it's 47. Let's go back and check it. It's 40, it's 30, 25, 47 right there. So I go ahead and buy a call right in here. And let's just check it. That price is around $47. You'd be buying a 1 or 2 strike in the money call. In this case, either a 46 or a 45 strike call. Okay, now you wait for the market to rally. You can take your profit right in here. You can wait till the close below the previous low right there. And here you can finesse it a bit. If you don't have a big run up, you can sell half here, hang on to the other half, and wait for a final leg up and sell for even more. So that takes a little bit of finessing and experience, but if not, you could have still sold here for a nice quick profit. And you notice, I don't know, how many trades have we looked at so far? 1, 2, 3, 4 already for just one stock in a matter of a couple of months. So you can imagine how many trades there are available that set up according to this method when you look at the over 100 stocks that meet our stock selection criteria. So it'd be very easy to be able to average at least 2 new trades a week. Okay, then again, if you missed that trade, the stochastics came down below 40 to 36. You got 5 percentage points higher. You could have bought a call option right on the open there and sold it a couple days later for a little bit of a profit, not much. But you notice we're not waiting around. If it doesn't move in our favor right away, you just take whatever you can and get out. Okay, now the percent K is trading below 60. The market's above the 50 red simple moving average. Stochastics jumps more than 5 percentage points right here. You could buy the call right in there. And in this case, you would be closing out your call for 50% loss. But that's the first one like that out of several trades. Okay, that's going to happen on occasion. There's no way around that, but that's fine because we know the odds are in our favor. Okay, now the market's below the red 50. The stochastics is above 60. It drops 5 percentage points right there. You buy a put option now because we're looking at the market going down. We're below the 50. And you can see this trade following the exit rule to stay with it until you get a close above the previous day's high. You wouldn't have got out until right in here. This trade would have made probably about 300%. Keep in mind, we're not applying any other criterion. This is it. And look how these set up for you. Okay, here's another one. You'd buy the put right in here. You'd be out here for a small profit. But you'd buy another put here. You'd be out here for a better profit. This one here didn't go above 60. This one 59.68, close enough. You'd buy your put here, out here for great profit, and so on. All right, let's look at another stock. Okay, this is stock symbol MU, Micron Technology. Again, compliments of freestockcharts.com. Okay, here's our red 50-day simple moving average. The market rallies, then sells off. Our percent K drops below 40, moves up at least 5 percentage points, and we go ahead and buy a 1 or 2 strike in the money call right here. With the stock trading at 32.75, we'd have bought a 32 or a 31 strike call. And then following our exit rule, the percent K has to be back up above 60, and we get a close below the previous day's low, and you could exit right there for a really fine profit, triple-digit profit. Again, the market sells off but stays above the 50-day moving average. The percent K drops below 40. It ticks up 5 points right in there. You could have bought a call right in there and exited here for a more modest profit. But consider the percentage of winning trades. It can be very, very high. Now the market falls below the red 50. We get the rally right in here, above 60. We drop 5 percentage points. We can buy a put option now right in there. And we would exit right here for almost a wash. Not much going on there. And you can see you want to exit when the rule tells you to exit. There's no sense in hanging on a put option if the market has the potential to rally like this. Turning a small profit or a break-even trade into a big loser. You don't want to do that. So never be wedded to your position. Just because you have a position doesn't mean the market has to make you a profit. So you've got to be vigilant in applying these exit rules. Okay, and then you just wait for the next opportunity. The market rallies. It's still below the 50. And you wait for the percent K to drop 5 points right there. You buy your put option right in here, and you get a dramatic drop in a couple of days. You could have exited right on down here for easily triple digits. Again, if you see that happen, if the market gives you a gift like that, take it. Don't wait around where it just plummets like that in one day. Yeah, it went lower, but you don't know that that's going to happen back at this point in time. Then you wait around, you see if we get above 60. No, we didn't. Over here we've got the market just above the downward sloping 50 moving average. The percent K is turned down, and the market's now closing below the 50. This is a higher risk trade at that point, but you could have bought one or two strike in the money put and had a pretty nice profit right in here. You exit that trade. And likewise again here, you could have bought a one or two strike put, and in this case a very excellent trade. And so on it goes. All right, let's look at one more. Okay, let's look at PFE, Pfizer. Here's the 50-day moving average. Percent K right here drops below 40. Ticks up at least 5 percentage points. You buy your call option here. Market chops around, goes nowhere. And then our percent K moves on up above 60. And we start looking for our exit point. We get a close below the previous day's low, and we're out right there. Another opportunity to get in here. The percent K is back below 40. It ticks up. We're back above the 50. You buy your call option here, and you've got an easily triple-digit gain here, exiting right up here. I hope you're starting to get excited. Scrolling forward, we get a percent K below 40 right in here. We buy a call option. A lot of choppiness here, but we would have gotten out. Regardless of where you got out, it would have been a profit. Not a big profit, but nevertheless a profit. Then the market sells off below the 50. It moves up above 60 on the percent K, and we get a chance to buy a put option right in here. Again, a lot of choppiness going on. Another chance to buy the put here for a pretty nice profit. Then we got the market rallying above the 50, percent K below 40. Moves up, you buy the call option for a small profit. And that's how you trade the simple trading method on the S&P 500 stocks that average less than $40 a share. It gives you the chance to buy the lower cost options. There are many, many, many setups so that it should be fairly easy to be able to, on average, enter into 2 new trades a week. Before we close out, I want to go back to the brokerage site and look at the option table for Micron Technology to make sure you understand how to read these tables. Okay, let's circle back now to the Options Express option chain quote page. And I've typed in symbol MU. And we're going to look at the calls, the November expiration, view the chain, and it brings up all of the prices for the different strikes. Now I want to point out a few more things to make sure you have this clear. So MU is trading at 1841. Well, if you expect the market to go up, what do you want to do? You want to buy a call option. Which one? Well, you want a 1 or 2 strike in the money. That would mean either a 18 or 17 call. 18 is in the money because it has 41 cents of real value. 17 has $1.41 of real value, and consequently it costs more than the 18 call. In this case, you could buy either one. Now look over here. If I click on detail a window pops up and it shows you in the middle at the top the delta, 0.59. That means that if Micron goes up $1 from 1841 to 1941, price of the option will go up at least 59 cents, probably a little more. That's the delta. Now, if you look at the 17 strike, the delta is going to be higher. You see, it's 0.71 because it's further in the money. So if Micron goes up $1, the option will go up 71 cents or more. Now, another thing to pay attention to is the open interest. Not the volume so much, but the open interest. Ideally, you'd like to have an open interest of at least 100 contracts. That means that's the number of contracts outstanding. Well, in this case, for the 18 strike, there are 3,200 contracts open. For the 17, 6,700 contracts open. So more than enough to give you the liquidity you need to trade this option effectively. And you notice with such high open interest, the bid-ask spread is usually a lot tighter than it was for the OKE example that we looked at. Where here you got a bid at $2.04, an ask at $2.10. If you wanted to buy, you'd split the difference, go in and buy it at $2.07, and very likely you would get filled. Now let's take a look at the put options. View the put option chain. And of course, if we thought Micron was going to go down in price, meaning our simple trading method's telling us that it's time to be buying put options, with Micron trading at 1857, we want at least a one strike in the money put. That means a strike price above 1857, or in this case 19 or 20. And again, if you look at the 19, it has real value of 43 cents, the difference between 1857 and 19. The rest of the premium is due to time value. If we go over here and look at the delta, it's 0.52, minus 0.52. The 20 strike is more expensive because why? It has real value of $1.43. So it's going to cost more, and it's got a higher delta of 0.64. But either one of these would be a good choice. If your account size is smaller and you'd prefer to buy the lower cost option, then do so. If it's larger, then you could buy the higher cost option, which will profit more quickly given a dollar move in the stock. But either one is a good selection. Now you see the open interest in this case is 25,000 contracts at the 20 strike, and at the 19 strike only 107. That means somebody went in there and bought a lot of put options expecting Micron to drop in price. Now if you consider the open interest, then that tells you that the 20 strike would be a better choice than the 19. You could still trade the 19. 107 is okay. It's just above the minimum that I like to consider. But with this one at 25,000, I'd be more inclined to pick the 20. Okay, then don't forget on any good broker platform, let's pick the 20 for example. Click on Calc. You should be able to do this with any good broker trading platform. The price for the 20 is 204.210. So let's go in and try and buy it at 207. Buy one, the 20 put, calculate, and there's the risk curve for the put. Until you get the hang of this and very comfortable with options, it's always a good idea to look at this risk curve so you can understand the relationship between the profitability of your position and the price of the underlying stock. Okay, basically that is all you need to know to have the potential to take a $5,000 account to $60,000 in 6 months. Now you've got one simple but very effective method for trading options. And I just showed you this one strategy alone could have a very powerful impact on your account size. potentially turning $5,000 into $60,000 in 6 months. All you need to do is spend 20 to 30 minutes per day scanning the 100 or so stocks that fit the criteria for this simple trading method, and a few more minutes identifying which stocks are currently showing the profitable setup situations that I just showed you. Or you can make it much, much easier on yourself. My team and I created an exclusive training and software program that automatically scans the markets and alerts you whenever a profitable setup formation appears. It's called the Options Profit Mastery 2.0, and I think you're going to be amazed when you see how much simpler, faster, and easier trading can be with this incredible software in your corner. Let me show you how it works. Every night after the markets close, it applies my filters for the call and put strategy to the best stocks and ETFs to see which ones would make good trading candidates. Then it displays the matches on the Trading Candidates tab, which you can see here. The stock and ETF column shows the symbol for the stock or ETF that made the cut, and you can click on the symbol to see an interactive chart. The latest price is also displayed here. The age column and the first appearance column tell you how recent the trading candidate is. Depending on the strategy, some of the candidates may still be good to trade for as long as 30 days. So you don't need to worry if you're busy and miss one here or there. Also, you can choose to have the newest candidates sent to your email or cell phone, so you don't have to keep checking the software for updates. Remember, the goal here is to teach you how to master options trading, so the software is only a tiny part of the overall program. You'll love using it to save time to quickly find the best trading opportunities each night. In addition to the software, you get digital access to the full call and put options training modules, which you can see here. These are full-length, professionally recorded training videos. And if you liked what I taught you so far about call and put options, you haven't seen anything yet, because while the information I taught you is very useful, there's a lot more involved with trading calls and puts, where you'll learn even more ways to use them to go after profit potential in ways you've probably never even considered before. As a matter of fact, what you've learned so far in the trading I featured recently is just the tip of a much larger pyramid. And while you can do okay using what you've learned so far, you really need to understand the complete picture before trading with real money. So get ready, because you're going to be blown away by how powerful the full training is. Also, in addition to all the video training, you get 2 full-color reference manuals. This makes it super easy to reference the diagrams, charts, and training presented in the training videos. You're also going to get a bonus training video that reveals all the step-by-step rules programmed into the software that'll teach you exactly how to find the best stocks and ETFs to trade with calls and puts. Plus, you're going to get a trading rules blueprint that summarizes everything you need to know to trade this method in one spot. This is like the secret sauce or the DNA of this method, and many of my students like to keep it by their trading computer for easy access. You get all this for free today when you enroll. Now, if you're brand new to options, I have 2 bonus training modules especially for you. The first one's called Basic Options Fundamentals, and I designed it to get you up to speed on the concepts and terminology you'll need to understand. And the second one's called A Deeper Dive, because I reveal critical options trading concepts that are easy to understand but often misunderstood, even by seasoned options traders. And yes, you also get these for free when you enroll. Now, I'm almost done, but there's still a few more important resources you're going to get access to, including access to the Options Profit Mastery members website, which you caught a glimpse of earlier. This is where bonus training materials will appear, as well as any updates to the program. This is the same website the full Options Profit Mastery students have access to. The only difference is that you'll just be able to access the straddles and strangles material. Plus, when you enroll today and become my student, I'm going to give you a full year of unlimited premium email and live chat support. This isn't some throwaway outsourced support either. I have a full-time support team of professional traders working with me in my office in Michigan that are here to answer your questions and help you succeed. If you have a question with a particular trade, let us know and we'll take a look. Every question is important to us, no matter how simple or complicated you think it is. So here's what you're going to get today. You get a full year's unlimited access to the Options Profit Mastery Trade Candidate software for directional trading with calls and puts, which is a $1,500 value. The Directional Trading with Calls and Puts training modules and Trading Blueprint, which are $2,500. The Basic Options Fundamentals training modules for $500, and a year of unlimited email support for $1,000. That's a total value of $5,500 so far. But I have an extra bonus I think you're going to love. Now, before we continue, I have to caution you about something pretty important. Everything you've learned so far is great, as long as the markets continue to move in a somewhat deliberate fashion. However, there's one market condition that, if it comes to pass, could render all of this training useless, unless you know how to modify it for this special condition. And that condition is the next market crash. If you've lived through the dot-com crash or the most recent October 2008 crash, then you know what I'm talking about. These life-changing crashes wiped out more than 50% of most people's investing and trading accounts. And if you don't think the market can crash like that again, you're wrong. It's a near certainty that we'll experience many more account-crippling market crashes in our lifetime. And many experts think the next one could hit at any time. Now, it could be next month or in the next year or two. No one knows exactly when, but it is coming. Unfortunately, most people will probably watch their accounts get hit yet again during the next crash. But it doesn't have to be that way if you know what to look for. Let me explain. You see, after 4 decades in the markets, I discovered 3 strange warning signs that appear before a major crash is about to happen. In fact, all 3 telltale signs have preceded every major market crash since 1929. And if you see all 3, that's a clear indication to get out now. In other words, you want to get out of your business as usual trading strategies and start using a specialized protect and profit strategy. Most people think you should just ride out the crash and hope for better days ahead. A painful strategy, to say the least. But my protect and profit strategy gives you ways to actually go after a ton of profit potential before, during, and after the crash. And if you're thinking, well, maybe I should just wait for the crash before attempting any trading, well, I have some bad news for you. If you wait for the crash, you're going to miss out on one of the biggest money-making events to ever hit the market. That's because every time a market crash occurs, there are quiet groups of smart traders who make an absolute killing because they know what to look for. So the smart move is to learn as many trading strategies as you can right now, especially while the market's still in a business-as-usual mode. Because no one knows the exact date of the next crash, it's best to keep trading and going after as much profit potential as possible and growing your account right now. Then when the crash hits, you'll be much more prepared than most traders. So while they're all scrambling and wondering what to do, you'll be calmly executing your protect and profit strategy to go after even more profit potential. My original plan was to turn this strategy into a big $2,000 home study course and release it later in the year. But because I believed the crash could be coming sooner than later, I taught this privately for my students on a webinar so they could get the information now instead of having to wait for me to produce a big product. So when you enroll today, I'm going to give you free access to the recording of this exclusive training event where I personally teach my protect and profit strategy. Coupled with everything you're going to learn about puts and calls, you'll feel unstoppable going after profit potential in the markets. And I can't wait to teach you this strategy. And by the way, I'm only giving away access to my protect and profit strategy if you enroll in my Options Profit Mastery program today. This is not available anywhere else, so this is the only way to get access to this important training. So let's recap what you're going to get today. There's the full year's unlimited access to the Options Profit Mastery Trade Candidate software for directional trading with calls and puts, the companion training modules and trading blueprint, the basic options fundamentals training modules, and a year of unlimited email support. Plus, you get immediate access to the private Protect and Profit training I did for my best students, which has a real value of $2,000. If you add everything up, that's a total value of $7,500. Your investment, though, is just 2 payments of $297 each. Now, that's 92% off the full value of everything you're going to get your hands on today when you enroll. I've got this at a point where everybody can afford it. So, if you're already trading options or if you've been thinking about trading options, believe me, you'll be amazed at how much profit potential you'll be able to go after using just directional trading with calls and puts. And I think you'll also be surprised to see how much less stress there is when you trade the way I teach you. I do want to give you a quick warning here. Only 500 copies of this program will be sold initially. If you've been following my training for any length of time, you know that this rule is nothing new. Every time I come out with a training program, I limit the number of copies I initially release. The main reason is that student support is my #1 priority. So when you become my student, I want to make sure that you're taken care of. I want to make sure your questions are answered quickly by my professional support staff. And I just think that's the right thing to do. And even though I could probably sell 5,000 copies of this program right out of the gate, I don't think I could support that many new students all at once. So when you enroll today as one of my charter students, you're joining a very select group of serious, like-minded traders who are looking for an edge over everybody else. Now, here's what you need to do next. If you want to discover how to go after double and triple digit returns in the safest markets trading calls and puts, what I want you to do is click the button right now. Just click on it and you'll get instant access to the software and all the training. You don't have to wait for anything to get shipped to you because everything is delivered automatically online. You could be getting the latest trade candidates and watching the training in just a few seconds from now. And you really don't even need to say yes right now. Just say maybe. And take the Options Profit Mastery Directional Calls and Puts Trading for a 60-day trial. Your satisfaction is 100% guaranteed. If you don't think this is the fastest and easiest way to have the potential to make more money more safely and more quickly trading options, or if for any reason you're not 100% delighted with it, just prove to us that you gave it a fair shot within 60 days and you'll get a full refund. You don't have to trade every week and it doesn't have to be a live account. We also don't care if you made or lost money. We just want to see that you gave it a shot. Now, if you already have one of my other training programs, the Options Profit Mastery Directional Calls and Puts software and training was designed to complement my other strategies, so you can feel good about adding it to your trading toolkit. Remember, there's not just one right way to trade the markets. And the more methods you have, the more ways you have to spot profit potential. It's kind of like golf. While you could certainly play 18 holes of golf with just a putter, you'd certainly do much better playing with a full set of clubs. So here's kind of a final word of warning if you're sitting on the fence about this. I want you to stop fooling yourself. You can't keep doing the same thing and expect different results. It sounds trite, but it is true. If you've been trying to make money trading, but it hasn't worked, or you feel like you're missing out on a lot of profit potential, or if you just feel like trading is eating up all your time, I'm going to suggest now that you try something different. It may seem obvious, but I can't tell you how many times people go out there, try a bunch of different trading methods, they don't make money, and they just keep trying the same stuff. Or they give up completely. Don't give up completely. I know you want to succeed at trading. Giving up is not an option. Doing the same thing over and over again when it isn't working is just silly. Don't do either of those things. Try something new. I want to let you know that consistently making money in the markets is hard without a good method that tells you exactly what to do and that removes all the guesswork. Anybody can go out there and gamble in the markets and maybe win a few trades here or there, but in the long run, gamblers get their accounts wiped out again and again. To build a real sustainable trading plan and actually achieve a consistent edge over time, if you don't have at least one good method that fits into your life schedule, I can tell you that it's probably not going to happen. Trust me, you're never going to achieve a consistent edge in the markets until you learn to trade with at least one good method that gives you confidence to make decisions, no matter what happens in the markets. Or maybe you already have a method that's working for you. If so, great. Keep using it. But I don't think you'd be watching this training today if you didn't feel like something was missing. So your option here is to either develop your own trading method or just get started today with one that took me months to develop and just plug it into your own trading plan. Remember this, the Options Profit Mastery directional trading with calls and put software and training gives you an edge over 90% of other traders. And I believe it's also the perfect add-on method to however you're currently trading, because it requires so little of your time once you get going. And just in case you're worried about it, this program is 100% guaranteed to work for you. It comes with my 60-day money-back guarantee, which is more than enough time for you to consume the material, implement it, and see the results. It's not a question of will it give you an edge, save you time, and shield your account from risk. Yes, it'll do all that. However, if you're worried about it, or if you're concerned that maybe it's not going to be a good fit for you, don't be worried. Go ahead, invest in the program, and try it out. If it doesn't work for you, let me know and I'll give you all your money back. There's no risk to you whatsoever. Again, the final reminder is that only 500 copies will be sold initially. That's it. I limit enrollment for all of my products. If you've been my reader for any length of time, you know that I bring training products out and then I take them off the market until I'm confident my new students are taken care of before I let more people in. It's just that simple. So what you need to do next is click on the button below right now. Go through the enrollment process and you'll get immediate access to everything. I look forward to seeing you in the members area, and I look forward to hearing your success stories after placing some trades yourself. This is Bill Polis wishing you good trading.